The U.S. national debt recently passed $38 trillion, putting the debt to GDP ratio around 120%. Historically, when countries reach 130% debt to GDP on the public level, there is a 98% chance that they will default, either nominally or through major currency debasement over the next 15 years. Hey guys, I'm Eric. Welcome back to your Monday Metals Market Update. We need to talk about what just happened in the financial markets, because if you looked at the closing prices last week, gold ending right at around $4,000, silver a little over $48, you missed the most terrifying panic signal since 2020. The prices look calm, but the deep plumbing of the system is failing. The entire financial world runs on one number: SOFR, Secured Overnight Financing Rate. This benchmark controls a staggering $397 trillion in global contracts. And last week, this number absolutely collapsed. It plunged 30 basis points to a two-year low of 3.92%. A nosedive that screams one word: panic. This drop of 30 basis points is significant. In the old days, we used to use what was called the LIBOR rate. Now we use SOFR, and that's the rate that banks use to transact among themselves all over the world. The fact that that rate is dropping means that the governments are injecting liquidity in the market, and they only do that if they sense something is very, very wrong. In addition to what happened with SOFR, the double whammy is that the U.S. injected another $125 billion just over the last 5 days. This stealth easing is now confirmed, and that means that where you have Powell talking about being tough on inflation, at the same time he's making emergency moves to jam capital into the markets. That screams of an issue that is not resolved, and one that should be very positive for us in the precious metals markets. Now, why do you think the Fed did this, and why can't they admit it? Well, the 4-year low that banks have in reserves is a critical point for the Fed. They get very, very nervous when they see banks starting to run out of liquidity or run out of money. That's when banks get really terrified, because all of a sudden then they go into rescue mode where they have to inject real capital in. So right now they're trying to drop rates, trying to make things a lot better, ease things, because they feel like we're coming into a recession. They feel like banks are at risk, and they're making moves as we sit here right now today. Now, gold, interestingly enough, held its critical support despite all of this chaos. There were a lot of bearish things that could have affected. They could have raised rates. The dollar has been strong. They could have been hawkish with their rhetoric. But the reality is they're under financial stress. The bullish undercurrent is that there is actually systematic financial stress. Why would the government inject $125 billion over the last 5 days? That SOFR signal collapsing, that also is very, very significant. So gold is clearly going to be an important factor in this. It's going to vacillate, but I think we're in a very good position to see it respond positively to this market. Now, we talked about debt, and this is something I came across that I really wanted to talk to everyone about. And that's the fact that we're sitting at above 120%. It's actually very close. I'm going to show you in the charts to 121% as it continues to creep up, that debt to GDP ratio. The reality is, in all the history of the world, when that ratio's gotten to 130%, there's a 98% of a complete fail. So the government has to take action, and they've got to do it quickly. The odds of a default are great. That is very positive for gold and silver. So we're sitting here kind of in what I'd call a metals perfect storm. Risk number one, SOFR, the fact that they're dropping rates. That $397 trillion market is under stress. Risk number two, the Fed is injecting capital. It's kind of a below the covers bailout, $125 billion going into the system. And then when we look at this debt to GDP ratio continuing to increase, I would call that risk number 3. And it's certainly one we need to think about. It's the convergence of all these factors that are putting tremendous pressure on fiat and stand to benefit us as investors, stackers in gold and silver. All right, let's take a look at gold. As you can see right now as we're filming, this is around 11 a.m. Mountain Standard Time. Gold's at over $4,100 an ounce. Yay! We're starting to see some pickup again. There's a lot of pressure. I'm not surprised at all in what's happening. You'll notice that difference between the top of the price when it got up to 43.72. If we come straight down and we look at the 200-day moving average at 32.72, there's a big gap. That's when you saw the market come down. Right now, even though gold's up, we're still continuing to see the upslope of the 200-day moving average, and that gap is much tighter than when it corrected before. We're also seeing that we're getting very, very close to crossing above now the 20-day simple moving average. That also, I think, is very positive for gold. We also notice that gold, when we look at the futures contract, is actually in a state of contango and not backwardation. When we look at silver, we see a very similar thing. You can see the big gap from when silver corrected against the 200-day, but now you see silver getting ready to cross its 20-day. It's much closer to the 200-day. You do notice that there is some still backwardation into December, but when we go out farther, out into March, we're now in a normal silver's contract. So things are starting to stabilize, I think, on the supply side as it relates to silver. This is an actual look from the Fred database of the SOFR. And as you can see over here in the right-hand corner, it's dropped below, and it's actually sitting lower than this. It's now at 3.92%. Very, very positive for us in the metals market. Now, if we look at the M2 money supply, well, guess what? It's continuing to go up. Obviously, they're continuing to print money. If we look at what's likely to happen in the next rate cut, which is due for for December the 10th, right now we're sitting at about 2/3 believing they're going to cut more, with a solid third thinking it's going to stay flat. I'm of the opinion of the majority. I think they are going to cut rates, and largely because we're seeing such a hit to the job market right now that they're going to respond to that. They're more concerned about that than they are inflation, still thinking that inflation is very, very low, although I'm about to show you that that's not true. So let's do that right now. Let's look at the Consumer Price Index and look how this number is moving. If we zoom in just over the last few years, you can see it's just continuing this slope moving up and away. So things are definitely costing more. We are definitely living in a period of inflation. And I think the actual reported numbers, that 2.7, 2.6, are very, very low compared to what people are actually experiencing in their daily lives. We also notice that the Fed funds rate continues to drop. So they're continuing to inject liquidity into the market. Now, if we go back to one of my favorite ones here on the national debt, you see now we're at over almost $2 trillion in debt. What's really interesting, if you look to the right, you'll notice the debt per citizen is $111,000, but the debt per taxpayer is $328,000. That basically is saying that 33% of us paying taxes are actually the ones who are paying the debt. That number has got to come up. It can't be solved by the 1%. It's simply impossible. All right, let's move now to the exciting part. Let's move to our forecasts, in particular with our private 30-day outlook. So first, it's really important that we get this down. There's this battle right now between inflation or deflation. Think of it as inflation or recession. Things going up in price versus the economy backing way, way, way off. The Fed is in a trap right now. Jobs are coming down. They feel a strong impetus to put money in the system. That drives up inflation. The goal of that is to try to stop a recession. They put the money in, try to create jobs, stop a recession. At the same time, what are they doing? They're pushing up inflation. So it's those two things that are conversion. It's that perfect storm that's incredibly powerful for gold, because guess what? It wins either way. All right, let's look now at some scenarios with gold. The bear case, if you look at that 200-day moving average we reviewed, is somewhere in that 36 to 3,800. The base case, as far as I'm seeing it right now, we're already at 4,100. It feels very much to me like we're on an up path and likely in that 42 to 4,500 range. And then, of course, the bull case from all the banks, UBS, Goldman, Bank of America, on, they're all over 5,000 in 2026. Now, if I look at my indicator, the one I use that I share sometimes with you guys, what we're showing right now, when I did this, was at gold at 40.83. We're actually projecting over the next 30 days with my tool it to get around $4,300 an ounce. That's about a 6% increase from where we're sitting today. Now, as it relates to silver, right around that 48, it's obviously significantly higher today. We've had a big move because these pressures are continuing, whether it's silver demand or the other things we've talked about before. We're showing silver, when I did it at 49.91, I believe we're over 50 right now, but we're showing it going up to around 55. That's a very significant move because that would put it at a new all-time high and be very, very relevant for silver going higher as we move into the future. If we look at that real bull case moving forward, you've heard this from lots of people, whether Bald Guy Money or other people on the internet, that 75 to 85 feels very attainable, especially when you consider the fact they're projecting gold to move to that $5,000 or so mark. If you just look at the GSR, it puts it very close to that 75 to 85 number. Now, when we think about investing, I also want to be very clear. The way you allocate between gold and silver, in my opinion, and again, this is not financial advice, but my opinion, is that it should be primarily age-related. When you're younger, buy more silver and some gold. When you get in the mid part of your career, I would start definitely leaning into gold with some silver. And as we get older, 65 and above and the like, primarily gold with a little pop with silver to gain some of that volatility moving forward. All right, so we are at, I think, an opportunity of the decade right now. We've got SOFR collapsing. We've got the Fed starting to inject capital and bail out the system. And at the same time, our debt shows no signs of turning around. So I feel very comfortable right now in my own positions to be long physical gold and silver. I encourage you to study for yourself, come to your own conclusion. All right, well, thanks so much for tuning in this week. We'll be back next week and with our Saturday video as well. Please like and subscribe. Please share. Do you know that only 92% of you viewing this are actually subscribers? Let's change that. Please subscribe to the channel. Thank you so much for being part of our family here. We both buy and sell at Summit Metals and look forward to doing business with you in the future. Happy stacking.